Okay, this is part 3 of chapter 3. And what we're going to do is look at specific examples, and we're going to start with the deferrals. And this is in your textbook, not these exact slides, but same concepts. So let's start with prepaid insurance. So here on January 1st, 2007, Scott Company paid $12,000 to cover insurance for the calendar year 2007. Like I said, your deferrals are usually incurred in the beginning part of your year, but are they true expenses yet? So here, Scott recorded the expenditure as prepaid insurance on January 1st. Those are journal entries. You've learned this in chapter 2, recording journal entries. So on January 1st, 2007, Scott Company is going to record this prepaid insurance. That's an asset account for $12,000, and then reducing his cash, so he'll credit cash by $12,000. Now, you got to note, an expense not incurred cannot be shown even if paid. So in this instance, cash has been paid, but the expense has not been incurred, so we cannot show it on our income statement. So now let's think about it. What adjustment will be required at quarter end? And the assumption they're making here is you have to make an adjusting entry because you're going to prepare financial statements as of 3/31. All right, so if I have prepaid insurance for the year for 12,000, I'm going to divide that by 12 months because this is insurance for a full year. So I've got 12 months worth of expense here. I'll divide it by 12 and then multiply it by 3 months. That's I have 3 months in a quarter, or you can think of it, a quarter is 1/4 of a year. You can divide the 12,000 by 1/4. But anyway, our adjusting entry. So here you worry about the amount, but also the entry that you're going to make. So as of March 31st, we've incurred 3 months worth of this insurance expense. So there's our entry, 3/31. We're going to debit insurance expense for 3,000. Remember, I take the full year 12,000 worth of insurance that I paid, and then what did I actually incur as expense as of March 31st, and that would be 3 months worth. So 12,000 divided by 12, multiply by 3. So here I have $3,000 worth of expense that I have incurred as of March 31st. And so I record the expense. Whenever you record an expense, you're going to debit it. And then I want to remove part of that prepaid insurance. I want to show that it's been expired, right? And that's exactly what the definition is. Let's just look at the T accounts. And there's prepaid insurance. That's an asset account. January 1st, there's 12,000 going in. March 31st, we have $3,000 being removed or showing that it's been expired. So the balance on my balance sheet as an asset for prepaid insurance is going to show 9,000. Meanwhile, on my income statement, I'm going to show the expense of $3,000. All right, let's look at supplies. So here, Scott Company, during the course of the year, purchased $15,500 of supplies. Scott recorded the expenditures as supplies. It's like an inventory account, so it's an asset. On December 31st, he actually goes and takes an inventory count. He's going to physically count his supplies. And it might be a closet, supply closet. And he does a physical count. Okay, I've got 5,000 boxes of staples. I've got 5,000, did I say? Sorry. Like maybe 10 boxes of staples, maybe like 10 packages of highlighters, and he knows what they cost, so he totals that up, dollar value, and he gets an amount. As of December 31st, there's a total of $2,655 worth of supplies on hand. So let's just first look at the initial entry. Okay, this is where we're deferring. So in 2007, he's going to record this asset supply account for 15,500, and then he'll show that he paid cash. But remember, an expense not incurred cannot be shown on your income statement even if you paid for it. So here we paid for it, but we have not incurred the expense yet. We didn't use any supplies yet when we recorded this purchase. All right, so at the end of the year, he does a physical count. So how much worth of supplies did we use? We'll just take the difference. If you had 15,500 in the beginning of this time period, but at the end, when you're ready to record an expense, you only have $2,655 worth of supplies on hand. Just take the difference, and that's what our supply expense. That's what we used. So I want to record an expense. So as of December 31st, I'm going to record supply expense for $12,845. And again, that's the difference between what I initially purchased and what I had on hand at the end of my calendar year or fiscal period before I prepare my financial statements. So the difference of 15,500 and then 2,655 will give me the fact that I used $12,845 worth of supplies. Granted, people may have taken some, customers may have snuck in there, took some of your supplies, but regardless, you have a supply expense as of December 31st of that amount. And then I want to reduce that asset. I want to show that I've used up these supplies, so I no longer have $15,500 worth of supplies. I only have $2,655 of supplies. So my asset account should be adjusted for that. So let's look at the T accounts, right? When I post these journal entries to the general ledger, to the T accounts for supplies, we bought 15,500. We used up 12,845. We're looking at the supply account. And so the balance in my supply account should show what I have on hand as of December 31st, and that's $2,655 worth of supplies. Let's look at the T account for the supply expense. That account will show up on my income statement. So I have supply expense of $12,845. All right, so that's our supplies. Let's look at depreciation. All right, depreciation is the process of computing expenses from allocating the cost of plant and equipment over their expected useful life. I purchase an asset, but I'm going to have maybe 20 years useful life of it. But that machine or whatever asset I purchased is going to help me in generating revenue. So remember, your expenses follow your revenues. So I need to do something, logically and analytically and say, okay, this makes sense. Let me take the useful life of this asset and take a piece of it as expense because it helped me generate the revenue during that period. We're just looking at straight line. We'll get into chapter 10. We'll get into depreciation um, more so, but right now, okay, in calculating your depreciation expense, you're going to have the asset cost minus the salvage value. That means what is it worth at the end of its useful life? What can you sell it at? And then you'll divide it by the useful life to get that straight line depreciation for the year. All right, so here's the example. On January 1st, Barton Inc. purchased equipment for $62,000 cash. The equipment has an estimated useful life of 5 years, and Barton expects to sell the equipment at the end of its life for $2,000. So there's my salvage value of $2,000. There's the cost of my assets, $62,000, and there's the useful life. So let's record the depreciation expense at the end of December 31st. Now this is what you want to be really, really careful of, and this is where they'll trick you on exams and multiple choice questions. Depreciation. We purchased it January 1st. We want to record a full year's worth of depreciation expense. If we purchase this asset on July 1st, but we only want 6 months then, be very, very careful on how you're going to calculate the amount of your expense. Okay, so here, there's our expense, 62,000 minus the 2 divided by the useful life of 5 years. So every year, I'm going to expense $12,000 worth of this asset. And remember, if we put it in service in that first year, as of July 1st, then that first year, I'm only going to take 6 months worth. So the amount would be 6,000. All right, let's look at our entry. All right, this is the normal a journal entry that we're going to make. And you know what? I need to stop here. But anytime you record depreciation expense, you're going to debit depreciation expense and you'll credit accumulated depreciation. Remember that. That goes hand in hand. No other accounts will go together like these two go. All right, let me stop.